I'm a product of the 80s. There's no doubt about it.
That's awesome.
Music and clothes style, all of it. All right, let me see where this graph is. Let me find that real quick. Okay. These two lines here basically plot what we call the intrinsic value upside, which is, again, intrinsic value divided by price minus 1. And it plots it to two portfolios. It plots it to high book to price or the cheap stocks, and it plots it to low book to price or the expensive stocks. During the tech bubble, the spread in intrinsic value upside between the cheap and the expensive stocks was about over 100%. The quant value guys made brilliant calls that made a lot of reputations, and that's wonderful, certainly warranted. That was a great move. But from an intrinsic value perspective, we saw the same thing. Now, what's interesting is, for us, value and growth has been more or less evenly priced over the last 20 years, except I'd say 10 years ago, growth became much more attractive than value. And that held until about August of 2020. This chart over here on the right shows the difference between these two portfolios. So you can see during the tech bubble, from an intrinsic value perspective, cheap stocks were 100% plus more attractive from an intrinsic value perspective than expensive stocks. And then for much of the last 10 years, this is the zero line here. This is the zero line here. Growth stocks were more attractive than value. More recently, starting in about August of 2020, we saw value becoming more attractive than growth. And that's certainly the point now. But I'd say it's about a third of as attractive as it was back in the tech bubble. I see nothing historic about this mispricing today. What I do see, going back to what conflates a ratio, Apple, Alphabet, Facebook, Amazon, these are extraordinarily profitable companies. These are not pets.com. These companies generate prodigious amounts of earnings and cash flow. You have low cost of capital, and these companies have high growth opportunities. A multiple, of course, is going to reflect these companies as having a high multiple. It has nothing to do with whether they're under or overvalued. A multiple is going to say they're expensive because, again, it conflates profitability, growth, risk, and competition. Those companies account for what, 25% of the S&P? Plus or minus, somewhere in there.
Yeah.
Of course, multiples are going to be high. So, yeah, granted, multiples may be at all-time highs, but from an intrinsic value perspective, which has a pretty stellar track record, these companies are certainly not trading at historic opportunities for growth versus value. Now, what might work out really well for the value guys is the fact that they're lower duration stocks. And if you get a big run in interest rates, it's kind of like just being at the right place at the right time, bus stop investing. The cycle comes and goes. As long as you stay in the cheap stuff, when interest rates start to go up on a relative basis, you'll do well. But, the thing is, from the perspective of what drives value investing, when you hold constant intrinsic value, the gains to value investing kind of go away. And this was in that white paper we wrote where we kind of laid out our asset pricing model, but it's what we call deconstructing value. And again, you have the 30, 40, 30 portfolios. And this row is the cheapest set of stocks, the best, the most attractive book to price stocks. This is the most undervalued stocks. The intersection does pretty well, 9% annual returns. But when you have fairly priced or overvalued stocks that have an attractive multiple, these stocks only return about 5.8%. So it really kind of, to me, gets at the heart of, this book to price or multiple investing is really kind of a correlation story, not a causal story. To me, the causal story is the stock's over or undervalued, and multiples are somewhat correlated to that, and that's fine. But you got to do a lot of work to sift the wheat from the chaff here. Regardless of whether a stock trades at a high multiple, again, this is 1998 to the end of the year, to end of 2021 live data, out of sample data that we've been delivering to our clients. If a stock's undervalued, it doesn't matter whether it's a high or low multiple. And the same lesson applies to duration stocks. In the current quarterly letter, when we broke down the sensitivity of stocks to changes in interest rates, I also did something else that I thought was kind of fun. was I broke down stocks on the basis of sensitivity, implied future growth. So stocks with higher implied future growth, all else equal, are going to be more sensitive to discount rates than stocks with lower implied future growth. So when we do that and we break that group of stocks up on the basis of whether they're overvalued or undervalued stocks, whether you have high or low sensitivity to discount rates, return about the same. Overvalued stocks, certainly the low interest rate sensitivity group is a little better, but 60 basis points, the bigger issue is the spread between undervalued and overvalued, regardless of whether you're interest rate sensitive or not. That tends to run about 200 basis points, plus or minus 130 basis points to 200 basis points. When you look at the same thing on a book to price basis, book to price does really well with low interest rate sensitive stocks. The cheap book to price stocks have a great return. But when you have high interest rate sensitive stocks, cheap book to price stocks have absolutely no explanatory power. That's the worst performing bucket, even though those are the cheapest stocks. So again, it gets back to I believe you just need a complete system to really evaluate stocks. You can keep adding more and more factors to try to plug the holes, but eventually you run out of fingers to fill up the dike, to plug the dam.